Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. Thanks for being with us. I'm Michael Bull. We have an incredible show for you today. This segment is brought to you by arborcrowd.com. If you're a sponsor of real estate developments, investing, or you'd like to invest small amounts of money in large commercial real estate deals, check out arborcrowd.com. Well, today we're going to talk about the single tenant net lease investment market. The freestanding buildings that we all love to invest in and love to broker as brokers. And we're going to get a view from a developer, from a broker, and from an operator of Zaxby stores. So we're going to have some different views. And I think there's a lot going on with single tenant net lease properties. They've always been a property type that investors like because they're very stable, long-term leases, credit tenants, not a lot of moving parts. And when you look back at the downturn, they kind of held their own on value more than most of other property types. But there's also a lot going on in the economy. There's a lot of restaurants that have been opening up in all the retail. We have some tax law changes. So what is in the future of the single tenant net lease world? We'll find out today. Please welcome my guest. I have Nancy Miller here. She's president of the National Net Lease Investment Group with Bull Realty in Studio One. Nancy, thanks for being with us.
Thank you, Michael.
We also have Fred Weir here with us. He's president of Meadowbrook Restaurant Group, and he's here in Studio One. Thanks for being with us.
Thank you. I'm glad to be here.
So let's talk about single tenant net lease properties, and let's look at your company, Zaxby. So how many stores do you have now, Zaxby stores?
Personally or as a chain?
Both.
We've got 12 stores right now ourselves. The chain is pushing right at the 900 mark. I think probably this year we'll be somewhere between 950 and maybe 975 as a chain.
Yeah. And Nancy, people that love to invest in these single tenant net lease properties, you know, as I talked to in the opening. So what do you see? One of the things that I think a lot of listeners and viewers might want to know about is the difference between corporate-owned stores and franchisee-owned stores. You know, the difference in the cap rates, and really, is there really a need for it? Is there more risk with the franchisee stores?
Well, that's a great question. Some of the franchisees, Fred, for example, is getting on the larger side, having 9, 10, 15, some have 50. Franchisee, when they get that large, the credit and the guarantee behind the lease is stronger. People usually gravitate to the corporate leases, corporate guaranteed leases, just because it might be a New York Stock Exchange guaranteed company and there's a veil of greater comfort. But your point is with for example, a Bojangles. I could buy a corporate Bojangles at a 5.5 cap rate. I could buy that same Bojangles as a franchisee at maybe a 6.25 to a 6.5 cap rate. So there is a difference in yield if the investor is willing to take a slight higher bit of risk. It may not be higher at all, really. In reality, if it's a strong operator who knows what they're doing and has some financial strength behind them. Yeah,
and that's interesting. I know some investors even like the local tenants or regional tenants that aren't national credit, which may even have a higher cap rate on some industrial users, some office users. But let's get back to kind of the single tenant net lease world that people think about mostly, and I think a lot of people think about that $1.5 million, that $5 million, the dollar stores, the fast food restaurants, the quick service restaurants. What are you seeing for volume and cap rate trends in that area?
Well, we just did a little look at it, the 1.5 to 5, and we looked at CoStar, and it's simply a sampling, an example of, and what was interesting is that we noticed that the number of transactions in 2017 actually went down about almost 14% over 2016, and cap rates went slightly down, maybe 10 basis points.
Down.
So the transactions and cap rates are going down, which is surprising because of, I think, a bit of supply and demand issue.
I see. And are you hearing from investors yet about their cost of funds going up, their interest rates going up on their mortgages?
interest rates right now are kind of hovering in just a hair above, but overall they are not a barrier to someone looking at 25-year financing. It's still excellent, and people are now looking at, they're trying to be a little bit more aggressive in cap rate. They want a little bit higher cap rate, and you're seeing a little bit of a lessening of cap rate or a weakening of the investor being able to get, they're going to get a 6.5 where they might have gotten a 6 before.
Cap rate?
So yeah, you're seeing them negotiate a little harder to get a little higher cap rate. But it doesn't always work because everybody's vying for the same property, and a cash buyer is going to be the one to be the victor every day if they're fighting with an investor who is looking for loan and leverage.
Right. And what do you see, Fred, in that area? I mean, you're a developer yourself. You own these stores. Do you think about interest rates changing? And that we're hearing that the Fed may raise their rates every time they meet by a quarter point. Do you think about that as you move forward?
We do. And with us, even negotiating with banks, we have very much changed kind of our negotiating strategy with them when we're going into it, trying to vie for kind of longer term fixed money. Certainly not anything that's variable or floating or anything where, even 4 years ago that wouldn't have been a consideration at all because rates just seemed to, they were going to be low for the next 50 years, it seemed.
Yeah.
But we're certainly seeing a little bit of that now, and we've had some banks that that have come back to us with interest rates and things like that are obviously higher than even we were getting 12 months ago. But even in our strategy, I guess from a competitive standpoint, we've kind of pushed them to stretch terms out longer, to go fixed for 7 years. Yeah. And in some cases we were even able to secure things at 10. So just to kind of hedge some of our risk and help us forecast better so that we could plan ourselves better and keep consistent P&Ls.
Yeah, well, and that makes sense. And I've seen some lenders out there offering 15-year fixed loans for the entire term, no balloon. And I think, having gone through a couple downturns in my career, I've seen where those balloons at the wrong time can wreak havoc on an investor. So if you can get a long-term loan, I think it's a good idea right now. Well, Nancy, what about investors who maybe they own some of these single tenant net lease properties? They've seen the cap rate compression, they've had a nice investment, maybe they're getting down from now it's not a 15 or a 10-year lease anymore, maybe it's 6 or 7 years. They're looking at interest rates and kind of look at, hey, if I'm going to sell in the next 4 or 5 years, if interest rates are going to rise, is it a time for them to consider selling some of the properties?
It absolutely is. An investor today, I could say this probably with 95% accuracy, their property is going to be worth probably at or more than what they purchased it at in the past, just because of cap rate compression. So the question is, mostly that we get is, what can I replace it with, and can I replace it with comparable cash flow? That becomes the difficult time. Though I often recommend that an investor who has a long-term lease look at year 8 to 10 to consider when they want to sell. Don't wait to 4 or 5 years, because then there's the risk to the purchaser of whether will they renew the option or not. So the optimal time to consider selling is in an 8 to 10 year remaining lease term period, I think.
Yeah, that makes a lot of sense. And I think another question that viewers may have today is about agglomeration, about stores that compete with your store coming into your market. So if I own some properties and all of a sudden there's competing tenants building and moving in the area, is that tough? Or if I'm an operator, do I want to be in a market where there's a lot of competitors and a lot of people coming to maybe eat and pick a restaurant when they get there?
To answer that, it's a mixed bag. And the reality of our industry especially is that there are no more meals to be served. Whether it's us or even casual dining or even more formal dining at every level, from the QSR industry all the way up to linen napkins, sit down. There really are no more meals to be served. If you build a new restaurant, there's not new guests that don't have access to you. Someone is probably already doing it, and what we or anybody else is doing when they open a new restaurant is you're taking someone else's guest. And so really the reality of it is, and we talked about this beforehand, it's you're only as good as your last meal served. And having operators and understanding that every day, and that's the reality for everyone across the board. Now, that being said, there are some areas where when you have more things come in, it creates synergy because it just naturally draws people in. But then, your obligation is that how well do you honor that trust factor with the guests that are coming there off of that synergy, and do every time that they come to you, is the experience consistently good? Do they know what they're going to get? And do you maintain and honor that relationship? And also look for new creative ways to get them there, because there are a lot of distractions. Both electronically as well as other things that are attracting people there. And so it can, but there also is the obligation that once you're there to make sure that you're firing in all cylinders so that they keep coming back.
Right, so you're not as concerned as some might think when competitors are there, or you're opening in a market and there's 3 or 4 other potential competitors coming, because a lot of people will show up. And I like how you keyed in on the customer experience. I've been to a couple stores, not Zaxby's, but other businesses in my market, and I like the product, national product that they do, but the service in these particular stores is terrible. So I think if you're an investor or an operator, you want to think about that. If you go to the store and the operator there is just terrible service, you might think, well, what's going to happen when this lease comes up? So I guess that's a big part of getting the right people in and the good service.
It's a huge part, and as simplistic as it sounds, there are operators out there that work for great brands, but they spend most of their time managing from a laptop.
Yeah.
And especially in our industry, I don't know that there are a lot of things that you can do to probably make a balance sheet or a P&L look okay. But at the end of the day, there's so many brands that are hot right now that 2 years from now you're saying, gosh, what really happened to them? And from my experience, a lot of those guys are managing from a laptop, and they don't have a connection with their guests. They don't have a connection with the people that they're employing, and it makes a difference. And at the end of the day, whether you're on the operator side or the investor side, you need to pay attention to that. Yeah. And certainly on the investor side, if you're looking to buy something out, it may be worth, if you have the ability, to go and actually hang out there a few times and see what it looks like.
Yeah.
Because believe me, there's a lot of things, and we do that even from our own internal cultural standpoint. We try not to spend a lot of time in the office, and sometimes go and hang out in our own stores, because you learn a lot.
Yeah,
and
that's a good point. I worked at a restaurant when I was in high school in Buckhead, Atlanta, and I realized when management wasn't there, the quality went down. And I think another thing that's very interesting to the audience is, how can you get better returns on your single tenant net lease properties? We're going to talk about that when we get back. And also, since we have an operator here, we have a broker, let's find out how some inside tips to figure out, hey, might this tenant renew? What is the risk here in buying this property? So stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.